A lot of economists have been talking about this as well. I think they're fielding a lot of questions from clients about what the heck's going on. I mean, I'm talking about weak fundamentals, but equity markets are on fire here. Helen Qiao came up with a report about the great divergence, right? A common theme was a stark divergence between weak macroeconomic fundamentals and improving equity market performance. But this is what they found out, right? Can it continue? They still agree momentum will weaken in terms of the economy in the second half. You have negative payback from front-load exports alike, but there is one underlying thing that is keeping this equity market going, perhaps in the near term, which is liquidity, right? So that certainly is the key thing that's driving things here right now. Let's dig into this a little bit deeper here. We've brought in Helen Qiao, also from BofA Global Research, Chief Greater China economist, also Jason Loy from BNP Paribas, head of APAC Equity and Derivative Strategy at BNP Paribas. He always talks about flows. We're going to talk about Helen first. Tell us a bit more about this dichotomy. And why do you think weak fundamentals are not bearish for the market right now?
Well, I think the market is probably looking through the fundamentals at the moment because of the support, as you said, Yvonne, that the liquidity has been pretty abundant. And at the same time, some of the things that the market was expecting previously, such as on the trade war front, is actually happening better than they originally expected. So I think they are looking over the current weak patch of the economy and probably thinking beyond that term. That said, I have to say that the current economic state is not necessarily at the extremely healthy one. We are seeing, especially last week, for example, money and credit data already show that there is a general lack of confidence in investment as well as in consumption. If you look at the retail sales numbers as well as fixed asset investment numbers, both are pretty weak. So IP was okay, mainly because that the export growth was fine for now, but we don't know for how long, right, because of such uncertainty in such a trade environment. So overall speaking, the economy is not in a great state, but investors are more than happy to look beyond that. Well, this is one of the few times that you probably do not necessarily see the fundamentals and the market go hand in hand, and that happens from time to time.
Jason, does the rally make sense to you?
I think both of you and also Helen brought up some very good points. So if we go back to Yvonne's point earlier about it's all about liquidity and something that Helen mentioned, when we think about liquidity, there are two parts to it, the quantity and the cost. When we look at the cost, the interest rate situation in China has already come down quite a lot. And when we talk about the quantity, I think recently there's an article suggesting that the Chinese household saving has exceeded 160 trillion renminbi. So you have low cost and a lot of quantity to invest, which is something that is quite unusual. Because if you go back to your earlier point, David, when you go back to 10 years ago, where Shanghai Commerce, where it is, the interest rate environment is also very different. So for a lot of domestic households, when they look at 10-year government bond at 1.6, 1.7%, and then all of a sudden the large cap companies giving you almost 3% yield, from an income generation perspective, the Chinese domestic equity, it's actually a very appealing alternative.
Yeah.
Yeah.
Well, I was going to ask you, Helen, actually, is the fact that the market's doing well, is that actually almost a sign that there's just really no other good alternative economic asset for consumers to put their money in at the moment? In other words, instead of leaving it at the bank, I'm going to put it in the market. Instead of buying property, I'm going to put it in the market.
Well, there could be some element of that, but, David, I'm not trying to reconcile the difference between the market and the fundamentals,
right,
which historically, I don't necessarily think that they always go hand in hand, as we said. But that said, I would say that indeed there is a general lack of confidence in terms of investment, and, for example, investing in property or, other type of assets. But that said, if you were saying that if people completely have no confidence in investing in anything, then would necessarily this equity market would be the only option, or they would rather hold on to all this cash?
Yeah.
So in an extremely deflationary environment, I would say that people would probably find it difficult to even put more money into the market. Even at a time when, as Jason was saying, that when the government bond is offering very little, they may be too afraid to put it into any of the equity market. So that probably implies that there are structural opportunities in certain pockets where people see much higher certainty and therefore higher probabilities of getting better profitability in the future. So they are looking beyond the short-term volatility.
It seems like after that data dump on Friday, though, people have actually reinvigorated their bets that we need more stimulus. are we likely going to get large stimulus, or is it going to become a drip feed of what we've been seeing so far?
Well, that's a very good question, Yvonne. But in our view, at the moment, the bar is still pretty high. The reason is that while the data from June to July is solid, it kept going down. However, is it as bad as it urgently calls for something immediate? Maybe not. And also, in our view, we think policymakers are still relatively comfortable with the current state of the economy, especially after a pretty strong second quarter. So first half being 5.3%, second quarter being 5.2 alone, were definitely a beat relative to the expectation everybody had at the beginning of the year. So, while the incremental news from monthly data is telling us that things are getting worse, we don't necessarily think that changes the mentality at the very top to introduce much more stimulus at the point. So we were lucky to see, the interest subsidy that came out last week. We think this is in a way to kind of like, comfort the market before the bad data hit. However, would that be sufficient in terms of, revigorating the whole economy and reversing the CPI and PPI deflationary trend? We don't think that will be enough, although it's a good start.
And Jason, one of the big drivers of this equity market, particularly onshore, have been this long dividends and long banks. Do you think that continues? And does that make sense given the economic reality still?
Sure. I think Helen brought up a term about confidence, and this is something that historically the China-Asia market is quite volatile. Right? We've seen a lot of boom-bust cycle in the equity market over the years. And since last year, what has changed is that we've now seen the government getting involved in the equity market by ETF. And if you look at year-to-date, the volatility of the China onshore market, let's say CSI 300, for example, is actually lower than S&P 500. So it's starting to create this kind of confidence-building process. It's going to take time. I don't think the onshore investors are fully believing in the market will continue to rally without seeing some improvement on growth. But when we think about equity market, there are two parts to it. There's the earnings growth part and there's the income generation part. So when you are struggling to get any income generation from other products, receiving roughly 3% cash flow from that process while waiting for the government policy to come in and translate through earnings, it's a more appealing process. And so that's why when investors look at these different themes, to Helen mentioned about different pockets, the so-called low volatility, high dividend investment theme, it's a nice way to carry them through until they see more specific policies being implemented.
Okay, where funds inflows are showing you in terms of where things can be sustainable? I mean, the beginning of the year was H share. Seems like A shares are now catching up. A or H, what do you prefer?
I think those are two very separate investment stories because of the market structure is very different.
Yeah.
If you look back at the Q1, right, it's all about the DeepSeek-generated excitement around technology, and that's where the Hong Kong market tends to shine because a lot of your large internet companies are in Hong Kong, and that seems to be going through a different process at the moment. But in turn, when some of the anti-involution policies start to come out, this is where the onshore market is better suited because there's a lot of traditional industry still being listed there. So I think we are now in this kind of transition period that for investor who wants to position for anti-involution, it seems that they're willing to put more money into the onshore market. But for those of them who are more into the AI-related stuff, then I think Hong Kong still offers something different. So this year, I think investors can actually find ample opportunity set if they're willing to go down into sector or thematic levels.
Very good point that Jason brought up, right? The state funds and ETFs, and I wonder, Helen, do you think the equity market is, although not directly, part of the policy cocktail of the government to reflate, let's say, reflate confidence?
I think it is part of that mix in terms of objective functions for the government. At least if you think about CSRC, I'm sure that they would love to see A share going up rather than going down. Right. But that said, I don't necessarily think that they have a numerical target to go to a certain level. I think the objective is actually to keep it stable and hopefully slightly up. But as long as it slowly gets a certain point, it is okay either way. So I don't necessarily think that policymakers wouldn't care about the stock market. And, even if it tanks, it's not part of their thing to watch. That's not true. I think policymakers in Beijing watch very closely as well. However, do I think that the entire, market performance was due to the Guojiadui, right? The national team's help? Probably not. I think that still was based on what Jason was saying, the DeepSeek moment at the very beginning and the earnings improvement later on. So I think that still has to come from the fundamentals. Well, that said, that also implies one thing, which is going to the second half. If we continue to beat the expectations of investors on company earnings as well as macro fundamentals, then we stay here. And the uncertainty, however, is that do we still keep the trade environment at a relatively stable environment? And at the same time, do we see domestic demand staying relatively stable? Or at this moment, money and credit data, which are leading indicators, are telling us that things are not looking that good.
What does the fourth quarter look like to you then? There's still a lot of debate about what exports are going to look like, what sort of payback we're going to see, if any. What's your take?
We think Q3, Q4 are probably going to do okay, but not as well as in Q1 and Q2. Obviously, we're going to have a higher first half and a lower second half. But Q3 probably has slightly more uncertainty compared to Q4. Okay. This is because that we may see some payback of the front-loaded export orders. You have bought a lot, in advance, and probably this is a time to destock a little bit. And we also see the potential challenge, for example, coming from the investment slowdown. You saw the numbers from the negative year-on-year numbers from fixed asset investment in July. This was not the first time it blinked in red, right? The June numbers was at 0.5% for headline, and both infrastructure as well as manufacturing investment growth numbers, which used to be the most important driver for FAI growth, were actually now down pretty notably. So we are seeing some downward momentum, and we do think that more policy easing is warranted, but we think that the timing of that coming out may still be probably more postponed into late September and probably October.
Jason, what do you make of the earnings season so far? And what does it tell you about where the economy goes, particularly guidance from companies?
Sure. I think so far what we have seen is a little bit more kind of divergence, right? When you look at how the earnings estimate has evolved, especially this year, we've seen a fairly concentration of that earnings optimism concentrated around technology-related stocks, probably for a good reason, especially after the DeepSeek movement. But for the past few weeks, as we see companies listed in Hong Kong start to report, we also start to see some divergence picture, even within some kind of technology-related stocks, right? We have, if you're a media entertainment companies, your earnings seems to be quite good. But if you're e-commerce, then there's some uncertainty regarding this intense competition when it comes to food delivery and instant retail. How much would it impact the bottom line? So I think even within the technology space, I think we may need another quarter or so to fully understand the short-term and the long-term impact of some of those competition happening in the e-commerce space.